In this video, I'll be going over financial statements, financial ratios, and you'll apply this learning to a financial literacy assignment this week. In business, financial statements are used to understand the financial health of an organization. Whether it's a company that you work at and want to know how it's performing, or it's a company you're interested in applying to, or perhaps while you're working in an organization, you are collaborating or engaging with another company and want to see if it's going to make sense to have a relationship with this other organization. The first financial sheet we're looking at is the balance sheet, which is a snapshot of the business's financial position at a certain point in time. The balance sheet provides detailed information about a company's assets, liabilities, and shareholders' equity. The formula you see here gives us the structure of the balance sheet. Assets are things that a company owns that have value. This typically means they can either be sold or used by the company to make products or provide services that can be sold. It can include physical property such as plants, trucks, equipment, and inventory, and it can also include cash. Liabilities are what the business owes to others. This can include all kinds of obligations, like money borrowed from a bank or money owed to suppliers for goods and materials. Shareholders' equity is the amount of money owners have invested into the company. This is sometimes called capital or net worth. It's the money that would be left over if a company sold all of its assets and paid off all of its liabilities. This leftover money belongs to the shareholders or the owners of the company. Let's look at some financial ratios that can be found using the balance sheet. Liquidity ratios help to measure a company's ability to meet its short-term obligations or debts. Note that levels of liquidity vary by industry, so it's helpful to compare similar companies within the same industry, which is what you'll be doing this week. I'll be showing you how to calculate some of these ratios using the financial statements of Thermo Fisher Scientific. The two ratios here are the current ratio and the quick ratio. The current ratio is a company's ability to pay its short-term obligations. Note that a 2-to-1 ratio is considered healthy, while less than 1 may be at risk. The quick ratio shows the ability to pay short-term obligations with its most liquid assets, so it's more rigorous than the current ratio. So over here on the left is the Thermo Fisher Scientific balance sheet, and on the right here is a ratio analysis spreadsheet I've prepared for the class. So you can see here I've got the Thermo Fisher Scientific example ratios already here. You will also be analyzing the Illumina financial statements, and you'll get to pick a third organization of your choice. You'll want to pick a company within the same industry so that it makes sense when you're comparing the ratios. So it'll be apples to apples. The current ratio compares all of a company's current assets to its current liabilities. Current assets are usually defined as cash or something that can be turned into cash within a year or less. Current liabilities are to be paid within the year. So if we take a look at the December 2018 column here, we can see that the total current assets is 10,625, which I've entered over here on our spreadsheet. And then as we look down, we're going to see that below assets is our liabilities. And so we're looking for the row that says total current liabilities, and that's the 6,147. And when I enter those numbers in, we get a ratio of about 1.72. The quick ratio indicates a company's capacity to pay its current liabilities without needing to sell its inventory or getting additional financing. That's why you see here in our quick ratios, it still has current liabilities in the denominator, but the top where it has our current assets, it's slightly modified. So there are two ways to calculate the quick ratio depending on the information that's available in the balance sheet. For this particular balance sheet, we'll be using the second option because I can see the total current assets, that is the 10,625. I'm going to look for the line that says inventory. So we're going to remove inventory, which is 3,005. And you'll subtract any prepaid expenses. So I'm going to look in here to see if there's a line that says anything about prepaid expenses, and I don't see it. So if I click on the box here, you can see I've done the math by taking the current assets minus our inventory. You can see it up here. And then of course my current liabilities is still the 6147. So when I enter those numbers in, I'll get my quick ratio here of 1.2396. Solvency ratios measure a company's ability to meet its longer-term obligations. It provides insight on a company's capital structure and how much financial leverage is being used. The debt to assets ratio shows the degree to which a company has used debt to finance its assets. The higher the ratio, the higher the degree of leverage, and consequently, the higher the risk of investing in that company. The debt to equity ratio identifies how risky a company is in terms of how much leverage it's using. It measures the degree to which a company is financing its operations through debt versus wholly owned funds. More specifically, it reflects the ability of a shareholder equity to cover all outstanding debts in the event of a business downturn. A ratio of 1 means creditors have claim to all assets, leaving nothing for shareholders in case of liquidation. The debt to assets ratio is essentially our total liabilities divided by our total assets. If we look at our balance sheet, we can see the total assets right here. So that's the 56,232. I've already got it on my spreadsheet here. But as we scroll down, it's a little bit trickier to find the total liabilities because there's no clear line that states it. However, we understand that there's a balance of total assets versus the liabilities and shareholders' equity. So when I look at my data here, here's my total of liabilities and shareholders' equity, and I do have the total shareholders' equity line. So what we'll want to do is we'll take the 56,232 and subtract the shareholders' equity out in order to find our liabilities. So you can see I've got my total liabilities and shareholders' equity, and I've subtracted the shareholders' equity piece to leave me with the total liabilities. Once we've calculated that, we can remember that and use it for any other ratios. So for instance, the debt to equity ratio here also has our total liabilities, but this time it's divided by our shareholders' equity. So we'll take the 28646 we calculated from above, and then for the shareholders' equity, we can see that here towards the bottom of our balance sheet, labeled as such, and we'll go ahead and plug in the 27,586. With our two numbers here divided, here's our ratio, and we can see that we do have enough shareholders' equity to cover our liabilities, but not much left after that. The next financial statement we'll look at is the income statement. It's also often referred to as the profit and loss statement, or P&L, and it shows the relation of income and expenses for a specific time interval. So you may hear in business, hey, something that we're doing can impact our P&L. That's what this is referring to. And these statements can be done monthly, quarterly, and annually. The bottom line of the P&L, or the income statement, shows the company's net earnings or losses. In other words, it tells you how much the company has earned or lost over the period. The 5 major categories that you'll see on an income statement are the sales, also known as revenue, the cost of goods sold or cost of sales, gross profit, operating expenses, and net income. Let's look at some profitability ratios, which lets us measure the firm's ability to earn an adequate return. The gross profit margin lets us know how good a company is at creating a product or service versus its competitors. The higher the ratio, the better. The net profit margin assesses if management is generating enough profit from sales and if operating and overhead costs are contained. Again, the higher the better. The return on assets, or ROA, lets us know how efficient management uses assets to generate earnings. The ROA takes into account a company's debt and is best used when comparing against similar companies or comparing a company against its own previous performance. Return on equity lets us know how effectively management uses assets to create profit. Being equal to or above average against your peers is good. Note that margins will vary among industries. Commodities, or products that can be easily replicated by other firms, will typically have low margins. Think oranges and coffee. Unique products with high barriers to entry generally have high margins. Think tech. So I'll go ahead and scroll down to our statement of income for Thermo Fisher, and then here are the ratios for profitability. So for the gross profit margin, we're going to take our gross profit and divide it by revenue. So I do have a note here in parentheses. In order to find the gross profit, you're going to take the revenue and subtract the cost of goods sold. So looking at our income statement, we can see that the total revenues from both products and services sold is 24,358. So we can see I've got that here in my spreadsheet. And then for the revenue minus our cost of goods sold, we'll take our total revenues here and subtract the cost of our product revenues and the cost of our service revenues. So we'll take these two numbers here and subtract it from the 24,358. That'll give us 10,857. Note that all the numbers I'm saying are in millions. Looking at the net profit margin, we'll go ahead and take our net income divided by our revenue. So we already had the revenue number, that's the 24,358, and we need to find the net income. So if I scroll down here towards the middle, so we can see here is the net income at 2938, and that'll go into our spreadsheet and give us our net profit margin ratio. Note for some of these ratios, we can also convert them to percentages when talking about them with others. So for instance, we would say that the net profit margin is about 12%. The return on assets ratio is the net income, which we previously found as 2938, and we'll divide that by the total assets. So I've got a note here that says the total assets can be found in the balance sheet. So we'd previously found that number at 56,232. And again, if you look above, some of the variables that we're plugging in, we already have, so you don't have to go hunt through those financial statements unless you just want the practice. Next is the return on equity, or the ROE. Again, that'll be the net income in our numerator, so that's the 2938, and then we'll divide it by the total stockholders' equity, which comes from the balance sheet. Again, we have that number above here, so I'll go ahead and plug in the 27,586, and that gives me 0.1065, or about 10.65%. The next financial statement we'll be looking at is the cash flow statement, and it details the cash received and expended for each month of the year. It measures how well a company manages its cash position, meaning how well the company generates cash to pay its debt obligations and fund its operating expenses. The main components include cash from operating activities, cash from investing activities, cash from financing activities, and the disclosure of non-cash activities according to the GAAP, or GAAP. So when analyzing the cash flow statement, the cash flow indicator ratios focus on how much cash is being generated and the safety net that it provides the company. Now, some companies that appear very profitable can actually be at a financial risk if they are generating little cash from profits. So the operating cash flow ratio lets us know how well our current liabilities are covered by the cash flows generated from a business. If the ratio is less than 1-to-1, we may be at risk of bankruptcy. The operating cash flow margin is the company's ability to turn sales into cash. Here, the higher the margin, the better, and we want to aim for growth and consistency. So if we look at the financial ratios spreadsheet, our last two ratios for cash flow are at the bottom, and I've gone ahead and scrolled to the last page in our Thermo Fisher Scientific financial statements, or the consolidated statement of cash flows. Now note that when you look at the different financial statements of different companies, sometimes they use language that's slightly different from each other. So it's a bit of a scavenger hunt when you're trying to find the pieces of information you need to calculate your ratios. So for the operating cash flow ratio, the numerator is going to be our cash flow from operations, and then we'll divide that by our current liabilities. Recall we already found the current liabilities from the balance sheet. So if I scroll up, we can see I've got my current liabilities was the 6147. So that's what I've got here in my denominator. And then for the cash flow from operations, that will be in the statement of cash flows. So the number that we're going to be working with is called net cash provided by operating activities. So you can see it's worded a little bit different from the formula here, but key things that we're looking for instance, are the term operating or operations, cash. So that'll be the 4543 that we plug in here. And then the operating cash flow margin, that's going to be our cash flow from operations. So it'll still be that same number, the 4543, but then we'll go ahead and divide it by our revenue, which we found in the income statement. So that was the 24,358 that we previously plugged in a couple of different formulas above. And that's how we do our financial ratios.